Hello and welcome to this month's monthly market report. So we are in September, which means we are going to break down the previous month of August 2021. So over the next about 20 minutes, we're going to break down the biggest topics in real estate, what's happened over the past month, so that you have knowledge and some perspective on the market as it stands today. All right, so probably the biggest news about the market right now is the drop in pending home sales. Maybe you've seen this over the past couple of weeks. It's kind of all over the news right now. So let's talk a little bit about that and this topic of, is the market starting to cool off? So we've seen the headlines out there. We've talked about it last month. It's being talked about all over the place, but let's look at pending home sales going all the way back to 2012. And you see right here, you can see we're kind of, dipping along there at a nice pace. We dip down during the lockdown and then come back up and pack a bunch of activity, a bunch of home sales in the summer of last year. And then the drop that you see there, the drop is that little red bar that I just put in there on the screen. Second, there we go. Okay, so that drop is that little red bar there. So you see that drop, we're still well ahead of where we have been historically, but off the highs of what we saw over the summer last year and, coming into the spring of this year, we're still hitting a little bit of that dip. So there we've got pending home sales. So I want to give you context about where we stand there. If we were to draw a line of what a healthy market looks like, this dotted line right here should give you perspective of a healthy market. So it's still a very, very good market right now, but it starts to put that drop in pending home sales into perspective a little bit. So I'll go to a quote here from Odetta Kushi. She says, "We are seeing some signs of softening in the housing market. Context is important here. We're still very much in a seller's market, but we're seeing some early signs of softening." So what we want to do here is focus on what I have in the blue there and underlined. Context is very, very important. Just like we looked at existing home sales, we want to look at everything. So we want to look at the last 10 years of pending home sales. We want, and we see this drop. It puts everything into context a little bit. So let's go through and look at a couple other things, and let's focus on the context of what's happening in the market now. So to stay on theme about, is the housing market cooling off? OJO Labs released this. They said the U.S. housing market continues to be ultra competitive even as new COVID cases surge, but new data shows the level of competition and ensuing price increases may be cooling off just slightly. Data shows that 49.6% of homes sold for more than the initial price in July, far ahead of the number reported in July of 2020, when 26.8% of homes were sold above initial asking price, but below June's total, when 54.4% of homes were sold more than they initially listed. So this quote is kind of a doozy. I had to go through and reread it several times before I understood it, so decided to just break it out and lay it out all here graphically. This helps me understand it a little better. Hopefully it helps you understand it a little better as well. So going back to July of 2020, we see that 26.8% of the homes sold over listing price. In June, we're looking at 50.4%, and in July of this year, we're looking at 49.6%. So there's your cooling off market there, or what they're saying might be a slight cooling off. So Only 1 out of 2 of the homes sold over listing price. So it's still a very, very robust market we're looking at here. Going back to what Odetta Cushy said, we're seeing some of these slight signs of cooling, but again, 1 out of 2 homes selling over list price certainly isn't what I would consider a cooling market, but now, if we want to talk about why we're in the market we're in, we have some graphs that I want to share with you that will sort of help lay that out as well. So let's take a look at those. Okay, so I want to start here with new monthly listing counts, and we'll look back going all the way back to 2017, but we have in here 2020 as well. So if you look at 2017, 2018, 2019, kind of following this curve, sometime around May, you start to see a peak in new listings coming to market. And then it starts to go down, and it starts to further dip down into October, November, and December. And that's what an average year really looks like for listings. But so you can see we kind of start out here kind of like a bell curve shape, peaking around May and then tailing off towards the end of the year. Well, you see there on the orange bar what happened in 2020. So that's 2020. So we started off on that normal pace and then we dropped down during the start of lockdown. People pulled So at the start of lockdown, people pulled listings from the market. And once lockdown was lifted, they started to bring those listings back in. But here's the key that I want you to look at. And you can just see it here visually. But when listings started coming back to market last year, we never hit this historical number that we'd seen in 2017, 2018, and 2019. We were shy of that. And you can see that here where we kind of hover there below and then tail off at the end of the year. So folks started putting their homes on the market towards the end of the year, but we never saw the volume or count coming to market like we had seen in the past. And there are a lot of reasons for that. There were folks that just said, you know what, I'm concerned. Life is really uncertain right now. I'm uncertain about health outlooks. I don't want to bring a bunch of people into my home. A lot of really valid concerns. And that's why we just didn't see the listings coming to the market. So that's been the cause of a lot of issues that we've seen in real estate. So now let's look at what happened this year, because it gets pretty interesting here. So as we lay in 2021, which is that green bar you see there, we're starting to come up a little bit, but again, very shy of where we've been historically in listings. And then, continuing to rise through that, normally that May time would have been the start to the annual fall off. And then, sorry guys, my light is just not working, so we're gonna do this in the dark from now on. So normally that May time period would have been the start to that annual fall off. And then, come through June and July, we're kind of flat right here. So as you can see, we're not having that sort of fall off that we've seen in the past, and we're kind of laying flat. So what's the moral of the story here? Well, the moral of the story is that if those listings start to fall, we're gonna see more upward pressure on prices. And if those listings start to climb and get in line with what we've seen in previous years, then we should see less robust price appreciation. So we're going to continue to watch that. I'll bring in some information on that on future monthly market reports as well. But that's what we want to watch. We want to watch listings and are they coming back to market? When we talk about a cooling market, we don't have a buyer issue in today's market. We have a seller issue. And, if we think about the seller issue or what that is the seller brings more inventory back to the market. So here's what Danielle Hale from Realtor.com said. If these changing inventory dynamics continue, we can see a wave of real estate activity heading into the latter part of the year. So if sellers continue to bring back listings, we could see a wave of real estate activity heading into the fall. So all that's going to be dependent on those that put their homes on the market. And that will largely be dictated by the path of the coronavirus and what's happening there. So a lot to watch there, but it gives you a breakdown of what we're seeing relative to the overall real estate market, what's happening with buyers, and certainly what sellers are doing right now as well. So I want to take a minute to talk about affordability. And one of the big topics in today's market is, those people who are saying homes just aren't as affordable as what they once were. So we're going to talk about affordability next. And this is a real concern. People are watching home prices continue to rise, and they're thinking, homes just aren't as affordable as they once were. And what I want to do now is give you some context and some clarity to be able to ease those fears if you are having some of those thoughts. So it's no surprise that, people are having these concerns as they're looking at data like this. So this is the monthly mortgage payment, and it shows how it's increasing significantly over the past few months. This goes all the way back to April 2020, where we can see those orange bars kind of humming along, and then all of a sudden, March, April, May, June, that monthly mortgage payment is starting to rise, and that is a direct reflection of home price appreciation. Now, when we look at this contextually, we can see that rising mortgage payment is contributing to affordability, and affordability is decreasing. So in this graph here, the higher the bar, the more affordable homes are. And in January of this year, it was much more affordable to buy a home than it is within the past few months. We can see that affordability has been decreasing. So saying that homes aren't as affordable as they were a few months ago, that's absolutely not up for debate. That's real. That's what the data is saying, and it's starting to spark this fear for consumers who may be sitting on the sidelines and kind of watching all of this happening. Now, I want to pull this graph up. This is one that I've shared, I believe, in last month's update. It's the Housing Affordability Index from 1990 all the way up to today. Now, what we can see here is that the blue bar over the right here shows that homes simply aren't as affordable as they were even over the past few years. And a lot of times what people think of when they say homes just aren't affordable anymore is they think of the housing bubble bursting. Those are the orange bars that you see there. That was during when the housing bubble did burst. So are homes as affordable as they were back then when distressed properties dominated the market? No, they're definitely not. But as we look at this chart, we can see that homes are much more affordable today than they were at any point leading up to the housing crisis. So leading up to those orange bars there. Now, this takes into consideration wages, prices, mortgage rates. So all of those factors combined, we can see that homes are still affordable today, but you're not going to get the deal that your neighbors and your friends maybe got a few months ago. So that's a price appreciation starting to play into affordability there. All right, so this is kind of where it becomes a real concern when we talk about renters who are sitting on the sidelines and watching all of this happening. So this is a graph for the median asking rent going all the way back to 1988. And it is continuing to climb year after year, and it's truly skyrocketing over the past couple of years, as you can see on the chart here. So as renters are sitting here saying, I'm seeing home appreciation price really starting to climb. I can't afford to buy a home. I'm not ready to jump into home ownership. What those people really need to understand is that the context, the context as well as rent prices rising even more rapidly, and the fact that they're not building equity and they're actually building their landlord's equity. So I want to make sure I really provide that understanding for renters who may be waiting because they're seeing home prices rise. But renting is actually creating this real long-term financial challenge for those who are waiting and continuing to rent. Now, here's another reason why renters may be sitting on the sidelines and waiting again, watching all this happen. And that's because the percentage of income needed for a mortgage payment is also increasing. Again, a reflection on home price appreciation. So we can see in this red section that that percentage of monthly income that it takes to purchase a home is now climbing even at a faster rate. It's really kind of jumping up, but let's also remember that if it's at 17.1% of monthly income right now, the historical norm is actually 21.2%. So again, context really helps shape this picture for anyone who might be waiting to buy a home. Okay, so let's hear what the experts have to say about this. So this is from Freddie Mac, and it's from their Essential Guide to Creating a Home Buying Budget. And it says, most lenders agree that you should spend no more than 28% of your gross monthly income on a mortgage payment. This includes principal, interest, tax, and insurance. So what are they saying? They are saying 28% of your monthly income can go to a home buying budget, and you're still in an affordable range. Now let's look at what NAR is saying, National Association of Realtors. They are saying the 25% mortgage payment to income share takes into consideration that a homeowner has other expenses, such as property insurance, taxes, utility, and maintenance. So that total housing expenses are no more than 30% of income. So housing costs are not burdensome if they account for no more than 30% of income. So NAR is saying if you keep your monthly mortgage payment to 25%, we know that there's also additional costs, property insurance, taxes, utilities, and those can also vary by market. So NAR is saying keep the threshold at 25% for principal and interest, and then you will have an affordable opportunity to purchase a home. Now, let's also put that into context. When you look at this graph, you can see mortgage payment as a percentage of income. So that green bar, that's where we've established the data is saying where we are today. 17.1% of income, monthly income, is going to a mortgage payment for those buying today. Historical average, we're below that. So that's the orange bar, 21.2%. And today we're also far below NAR's guidance of saying that 25% of income can go to a mortgage payment. So when we put all of that context together and we see in the green bar where we are today at 17.1%, it feels like it's climbing, and it is. That number is going up, and it's not as affordable as it was to buy a home even just a few months ago, as we've already established. It's not as affordable to buy a home as it was during the housing crisis, but when we look at the context going all the way back and we put that into perspective, what we know today is that homes are less affordable. That's not up for debate, but they're not unaffordable. So I want to say that again. Homes are less affordable, but they're not unaffordable. And what we need to remember is that if you can find a home today, purchasing a home is going to create much more long-term wealth benefits, especially when we factor in equity and rising rental prices and really building that long-term wealth. Okay, so let's talk a little bit more just about this market, because I think one of the concerns that people have is, are we heading into a more normal market? We saw folks saying on the front end, some expert quotes that I showed you, they're saying the market is starting to cool. Maybe we're not in this hyper competitive market. It's still a very, very competitive market. It might be cooling down a bit, but I do want everyone to remember that it is still a very competitive market. So here's 5 reasons why today's housing market is anything but normal. And let's remember the definition of normal is to conform to a type, a standard, or a regular pattern. So let's take a look at these reasons. So the first topic that I want to talk about is mortgage rates. So If you think about mortgage rates, that's what's fueled the demand over the past year. No doubt the meaning of home has changed, but when we did see earlier, we didn't get the listing inventory that we needed. And then, oh, by the way, rates fell. So if you start to look at rates by decade, the 70s, 80s, 90s, 2000s, 2010s, seeing, what we would maybe call more normal rates. Certainly an interest rate in the sixes, maybe in the fours. Fours are even low by historical standard, but you go back to the 70s, the 80s, and 8% was not considered a very high rate. You go back to some of the highs back in some of the inflationary times, you're looking at plus 10%, 15%, whatever the case may be. So let's look at today. Today we sit at 2.87% on the average 30-year fixed. So a lot of the instability maybe in the world, some of the issues with the job market right now are giving us lower rates for longer. So still very, very good rates. We certainly wouldn't say that's normal. We certainly wouldn't say that's a normal market by historical standards at all. All right, the next thing I want to look at is home price appreciation, and that's going to be something we want to look at and say, okay, are we heading into a more normal market as well as, or when it comes to home price appreciation? So if you look at home price appreciation by the year, most recently right here, according to this Black Knight study, 14% home price appreciation. And you're seeing higher numbers come out of the, come out of Case-Shiller and some other places that are recording this data, but 17%. So a lot of appreciation in homes happening right now. And you see the red bars there in the middle. Those are the years that the housing prices where we saw depreciation in the market. But what we know right now is that the average appreciation, you see it, the orange bar in the middle there, 4.1%. Now it's interesting, the average appreciation we talked about is 3.8%. The last couple of years of strong appreciation, plus 10% appreciation, have raised that to 4.1%. So, the appreciation that we're sitting in right now is anything but normal. We're seeing very, very heavy, robust appreciation across the country. So months of inventory of supply have been the biggest issue in housing, no doubt, over the past year. So let's take a look at where we're at with that. So NAR says this: month supply refers to the number of months it would take for the current inventory of homes on the market to sell, given the current sales pace. Historically, 6 months of supply is associated with moderate price appreciation, and a lower level of months of supply tends to push up prices more rapidly. So, month supply gives us, there are this many homes on the market, 10 homes on the market. We sell 1 home a month. We have 10 months supply. We've been nowhere near that for quite some time. And we see this balanced market typically being between 4 and 6 months. So where do we sit today? 2.6 months of supply on the market. This graph here looks all the way back to 2011, so 10 years, and you can just see this ride down to where we sit in the lack of inventory across the country. And that's anything but normal. We need more homes on the market, like I've talked about before, and this fall market will really be dependent upon how many folks put their homes on the market coming up. Number 4, the days it takes to sell a home. What typically it's taken to sell a home as compared to today's market. As of July, 17 days to sell a home. You go back and you look at this graph, and going back to March of 2019, you see some of the days there, 42, 49, some of the peaks. Think about that, a month and a half to sell a home. That's not an unrealistic time frame, but 17 days, I mean, that's that's quick. That is a quick time frame to sell a home. And likely that number is shortened, right? That's probably the time that everything is, signed, sealed, delivered. All I's are dotted, our T's are crossed. But homes are selling very, very quickly, and that is anything but normal with respect to where we stand with days on the market. All right, so now let's talk about average number of listings and offers. So the number of offers that are made on average on a listing across the country, we go out and look at that number. So typically we've seen that range around a couple of offers on the average listing according to NAR. And currently we're at 4.5. So, if the peak was about 5 in the spring market this year, but certainly not a normal market relative to the number of offers that are being received on listings. We want to keep that in mind because people say, well, the market may be cooling off. Is this something we're heading into, something that's more normal? And the answer is no. When we look at what's happening in real estate today, it really is anything but normal. All right, so now the last part of this, I want to take you into some market sales stats for a couple of the surrounding areas. So let's start with, all right, this says July market. That's wrong. It should be August market data. That'll be for the next few slides. So August market data for Philadelphia counties. So a little over 2,300 homes were listed, almost 1,700 homes were sold. You can see the listed median price and the sold median price there as well. For Bucks County, we're looking at 942 homes listed, 933 homes sold. The sold median price being about 19 grand over the listed median price. For Montgomery County, 1,253 units listed, just about 13 units sold. Again, median and sold median price there, listed median and sold median price. And then for Delaware County, we're looking at 827 units listed in August, 756 units sold, and again, listed median price as well as sold median price for August as well. All right, and there we have the monthly market report for August of 2021. See you next month for the next update.